Hi, I'm Lauren Saidel-Baker, a speaker and economist here at ITR. And as we are rapidly approaching the second half of the 2020s, I'm starting to get questions from my clients about what should we do to prepare. Uh, the questions that they're asking most frequently is, well, the obvious one. Will we see growth in the second half of the 20s or will we see a recession? Now, the good news is that our ITR perspective has for quite a while been that the second half of the 2020s will be a relatively prosperous time. Clearly, there's always the potential for certain industries to contract, but overall, we're expecting good, steady, stable growth for most of this half of the decade. So look ahead to those opportunities. As I like to say, make hay while the sun shines. And my question to these clients is always, what are you doing to prepare for these years of growth? There should be investments that you're making today. Even today, with interest rates relatively higher, with that much higher cost of capital than we've all become accustomed to. I'm seeing a lot of belt tightening, a lot of just hesitation, waiting to see, will the Fed cut interest rates? Will we get a clearer view of the economy going forward? Well, we'll always get a clearer view if we wait for it, but by then it's too late to seize on these new investments that would have prepared you for this coming growth cycle. So look to your people. Do you need to be hiring this year? The labor market is very likely going to loosen marginally. It won't be a material wholesale change back to where our labor market was a few years ago. So prepare for that ongoing tightness. Scoop up top talent this year while you still can, and probably get some reasonably good prices on that talent. But beyond that, we need to make efficiency improvements. There simply are not enough unemployed workers to go around. There are over 7 million job openings today. We don't have that many workers waiting to take these positions. So look to your company and how you can do more with less or even with the same number of workers. That's going to take investment. It's going to take capital. Again, even with interest rates relatively high as they are today, these improvements, if they can gain efficiencies, they will still help your bottom line. Watch that margin position going forward. If we can improve worker productivity in your business, that's the first step for that margin problem. Now, we're also looking ahead at what metrics should we face? What data points should we be watching as we enter the second half of the 20s? One that we've been concerned about here at ITR for quite some time is the next round of inflation is already starting to build. So while today, as I'm sitting here in the first half of 2024 from a very disinflationary environment, we're starting to see trends in, say, the money supply, in a lot of the leading indicators that we follow, signal that that next round of inflation is coming in 2025 and beyond. So I'll be very concerned about pricing and those pricing pressures. Again, I already mentioned wages. Look for wage pressures to be building for most of these years. And inflation overall, we have to get used to a higher inflation environment than we've seen in the prior decade. So what does that mean for your business, for your pricing? If you have a good, better, best model, do you need to be substituting? Do you have the right ladder, the right structure in your products that if your customers are starting to get worried, starting to look to tighten the belt, maybe they can get just the good or the better option? Do you have that pricing flexibility? Additionally, we will want to watch the US consumer. Recently, we've seen very mild deterioration in consumer finances. I hesitate to even say that because our consumer is in such a strong position today. We're coming from such a historically high starting point that some amount of deterioration, well, it's acceptable. We never want to see it, but we do have resiliency in the consumer. So while we're reading very scary headlines about the amount of credit card debt out there, keep in mind that credit card debt on a dollar value basis is a record high today, but on an income basis, credit card debt as a share of median earnings, that's only about 14%. That's a pretty healthy level. It was above 15% in 2019 pre-pandemic, and back in 2007, 2008, it was above 20%. So we're actually on stable footing. Watch the consumer for those pockets of concern. We see some starting to pop up, especially in the lower end of the income distribution, but our middle and upper income consumers, they're very resilient. They're going to be carrying this ship forward. Now, tools are incredibly important. They're critical in your business planning going forward. So what tools can you leverage to better plan, to better prepare as we enter this back half of the decade? Well, I think an accurate forecast of where your business is headed would be my number one stop. That's something we can do here for you here at ITR Economics. But if not your own sales or revenue projections, look to your industry. I'd really want to be watching both dollar value spending, so new orders or wholesale trade, depending on your sector, even something like service revenue if you're on the service side, as well as volume based indicators. So, again, we're expecting moderately higher inflation for the rest of this decade. It will be important to decouple that pricing category from that volume category. Be sure you have an accurate view of both sides of the business, so indices or unit value counts. We have about 14,000 indicators in our database. Chances are we have a few that you might be interested in. I would encourage you, go out and find the data. Don't swing with the winds of sentiment. Find the numbers and use those in your planning. We're wishing you all the best as we enter this back half of the decade. Take these tools and, again, make hay while the sun shines. Enjoy the rest of this decade.